Hello everybody, my name is Stefano Cabello and I'm a junior analyst at JP Morgan. I'll be serving as the lead forecast analyst for this presentation.
Hi everyone, my name is Benjamin Dalusma and I'm also a junior analyst at JP Morgan, and I'll be serving as the main credit analyst for this presentation.
Hi everybody, I'm Kelli Keith and I'm a junior analyst at JP Morgan Chase as well. I'm the lead financial analyst on this presentation. And together we are Investment Banking Group 2. So we will begin our presentation now.
Today, I will begin our presentation to Yahoo about a capital raising opportunity. So today, we will be following this agenda. First, we will present the credentials of our bank, JP Morgan, as well as our management team. Next, we will provide an overview of current market conditions as well as an overview of Yahoo as a company. Then, we will discuss our analysis of Yahoo's financials as well as evaluation of the company. Finally, we will present a funding proposal as well as a roadshow recommendation for Yahoo. So, we are JP Morgan. JP Morgan is a leading global investment bank. We serve nearly 20,000 clients in more than 100 countries. We offer a complete range of financial services to help clients achieve their goals. We were founded more than 200 years ago and have a proud history of only doing first-class business in a first-class way. In the words of our chairman and CEO, Jamie Dimon, our aim is to be the world's most trusted and respected financial services institution. If you turn your attention to the chart at the bottom of the slide, it shows JP Morgan is the lead investment bank in debt issuances for 2012. Now, this trend is continuing into 2013. According to Global Finance, we are the #1 global investment bank and the #1 in debt issuance in North America. Now, please see our management team. We come to you with experience in 5 different industries. Now, I'm going to turn the presentation over to Stefano so he can talk to you about the macroeconomic outlook.
Thank you for the introduction, Kelly. Again, my name is Stefano Cabello, and I'm going to talk about the macroeconomic outlook in the United States, the equity and debt capital markets, and the internet media industry group that Yahoo is a part of. A big topic recently in the news has been the Federal Reserve's quantitative easing program. It consists of $85 billion a month purchase of government and mortgage-backed securities that has produced an environment conducive for investment in equity markets. The Federal Reserve's QE program, in effect, has made long-term interest rates at historic lows, which has made equity securities look much more desirable as compared to bond securities, due to the fact that equity securities promise and deliver a much more higher yield and return. In June 18th and 19th, in the Federal Open Markets Committee meeting, they announced that QE tampering was in the horizon. QE tampering is the reduction and eventual exit of quantitative easing. This had many effects on our financial markets. For example, there was a spike in long-term interest rates, and a subsequent capital outflow in fixed income securities, and a sell-off in the stock markets. Another big item in the news agenda has been, when is the QE reduction and exit going to be? A recent poll by the Wall Street Journal of Economists say that 53% of economists think that September is a viable QE reduction, a reduction that's probably going to be to $65 billion as opposed to $85 billion. But we must remember that this decision will be made according to economic data. Let's go ahead and transition over to economic performance and look at different indicators that gauge that performance. The International Monetary Fund reduces United States growth forecast from 1.9% to 1.7%. The unemployment rate is currently sitting at 7.4%. I think it's good to keep in mind that the Federal Reserve will continue doing their quantitative easing program until the unemployment rate hits 7%. 162,000 non-farm jobs were created in July. This is still below the 200,000 mark that a lot of economists say will signal that our economy is in a recovery stage. Home prices surged 12.2% in May, the highest has been in 7 years. This demonstrates that there was a lot of demand for home prices, which is a very good indicator for our economy. Auto sales grew 9.2%, translating into a seasonally adjusted annual rate of 15.96 million units. A lot of these auto sales were purchases of trucks, but this indicator demonstrates that consumers are slowly making their back into making bigger purchases, which is also a very good indicator for our economy. The National Purchasing Managers Index is currently at 55.4%. A good rule of thumb is that if the PMI is over 50%, that suggests that the economy and manufacturing sector is expanding, so this 55.4% is another good indicator. Below we have a US GDP growth chart. As you can see, the United States economy finally started growing in 2010, and it's been moderate growth. Due to all these different indicators and looking at our US GDP growth, we believe here at JP Morgan that the United States is in a mixed recovery. It's still not in a full recovery due to downward pressures from unemployment and not enough private jobs being created. Let's go ahead and move forward to our equity capital markets analysis. On the left, we have the Nasdaq adjusted close. As you can see, over the year has performed very well. So let's take a good aggregate equity market analysis. So as increase in interest rates will have downward pressures on equity markets, so the increase in interest rates will have somewhat a negative effect on equity securities due to the fact that equity securities will no longer be seen as such a desirable security due to the fact that bond yields will soon offer much higher returns with a lot less risk. The S&P 500 simple moving average is currently at 1,649.15. Right now, yesterday, August 21st, 2013, the S&P 500 closed at 1,642.80. Whenever any major index closes below their simple moving average, this is an indicator that that particular index or market is in a bear market. Emerging markets such as Brazil, Venezuela, and Egypt, and many others are suffering from civil unrest and the prospects of QE tapering. So as QE tapering starts to take effect, as we have already seen, a lot of money that flowed into these emerging market economies are going to flow back out due to the fact that higher yields are here now in the United States with a much less risk associated with that return. The Conference Board Consumer Confidence Index dropped from 82.1 in June to 80.3 in July, and this is kind of a negative indicator due to that consumers drive our economy by 2/3. So a lot of major stocks like at Apple and Chipotle drive their sales and revenue from the consumers. So if the consumer isn't confident about the economy, that's a suggestion that they won't be spending out as much on products. The S&P 500 current PE ratio is currently at 18.23. The median PE ratio dating back to the 1880s is 15.5. So the fact that the PE ratio right now is higher than it has been historically suggests that some of the stocks that are in the S&P 500 are overvalued. Now let's go ahead and move to the debt market overview. On the left, we have the 10-year Treasury. It started out at a yield of 3.81 in August 2008. And right now, it's currently sitting at around, in August 2013, at 2.71. Now let's do a fixed income security analysis. So as interest rates increase, as the economy improves, fixed income securities will be more attractive than equity securities in the long run. So right now, in the short run, fixed income securities are going to be suffering due to the increases in interest rates, which leads to an erosion of their value. But in the long run, as bonds will offer much higher yield, a lot of money is going to be going to securities due to that fact. The federal funds rate is between 0 to 0.25%, so that's going to be definitely a downward pressure on short-term interest rates, and we believe this is going to keep short-term interest rates at lows. We expect interest rates, or more likely the yield on the 10-year Treasury note, to reach 4.5% as the economic cycle reaches the peak stage, which is probably going to be around 2016-2017. As measured by the Consumer Price Index, 2003 inflation will be approximately 2% as compared to 1.7% in 2012. As we all know, inflation can be a bad thing for fixed income securities, but we think that inflation has been shown, which as we see in our chart has been historically been tamed. We don't think that inflation is going to increase that much and is going to be at lows and shouldn't erode bond values. Our takeaway from our financial markets analysis is that our economy is improving, but we still need to keep in mind that there are some barriers that our economy needs to overcome before a full recovery stage can be realized. Let's go ahead and transition into our internet media industry overview. Some statistics that we definitely need to talk about are the internet data usage statistics. As of the first quarter of 2013, there were 2.7 billion users worldwide. The global growth rate in 2012 was 566.4%. We also need to keep in mind that this is a very impressive growth rate, but we expect to see such high growth rates going forward due to the global penetration rate, which is a measure of the number of people that are currently on the internet. So right now it's sitting at 34.3%. This demonstrates that 65.7% of the world is still not connected to the internet. So as these people move towards the internet, there was going to be a lot of growth seen in the internet media industry group. The U.S. social media market share of visits as of May 2013 is currently shown below. Yahoo Answers has 1.16% of the market, and Tumblr, a recent acquisition of Yahoo, has 0.51% of the market. We definitely think that Yahoo is taking the right steps to increase its social media market share. We'll touch on those a little bit later. The desktop search market share, which is something we definitely need to look at, and it's very important right now in this industry group, is shown below as well. Google has 83.16% of the market. They're the main dominator of the market. And Yahoo has 8.05% of the market. Again, we believe that Yahoo is taking the necessary steps to increase its market share. For example, Yahoo has a plan to hire 50 PhDs so they can work in the R&D department and focus on desktop search and just search in general. The global mobile desktop search right now is also shown below. Google has 84.55% of the market, again a main dominator, and Yahoo has 6.68% of the global mobile search market. Again, we think that Yahoo is taking the necessary steps, such as creating a department that is solely focusing on mobile. Let's go ahead and transition to investment considerations. So, mobile advertising has an increasing capacity for growth. We believe that mobile is going to see the most growth in online advertising. The best mobile internet companies will create reach with subscribers, platforms, and developers. But also need to keep in mind that this is not transitioning to mobile is not an easy phase, and it's going to be difficult to launch effective and profitable mobile ad products. And lastly, something to consider is that companies that deploy a successful social media strategy will outperform those that create and aggregate editorial content. Right now, Yahoo has a very small share of the U.S. social media market share, but with this recent acquisition of Tumblr, we think that Yahoo is definitely trying to increase their market share and is taking the right steps. So right here we have a chart showing the online advertising historical revenue mix. So from 2003 to 2012, the online advertising saw a growth of 19.7% compounded annually. This is a very impressive growth rate as well. And we still believe that the online advertising is going to see impressive growth because, as we just mentioned, a lot of users in the world are still not online. So as they go online, we expect online advertising to continue to increase. Here we have the advertising format share breakdown. We have search, display banners, classified, mobile, digital video, lead generation, and rich media. Again, we want to focus on mobile right now because we believe that mobile is going to see the most growth. Actually, in 2012, mobile saw about a 200% growth rate. That is very impressive, and we still believe that mobile is going to continue such an impressive growth rate due to the fact that there are many initiatives and investment into mobile's infrastructure. I think one of the biggest ones and most publicized one is Internet.org, an initiative that is being led by Facebook, Samsung, Nokia, Qualcomm, which is aimed at drastically cutting the cost of delivering basic internet services on mobile phones, particularly in developing countries. We think this is a very great effort, and we know that Yahoo is going to definitely be a party that will benefit from this effort. So there's still going to be a lot of growth on mobile. And other things to look at that will continue to lead to a surge in mobile growth is faster connection speeds such as 4G and LTE, increased sophistication in incorporating ads into mobile apps and website, and growth in device penetration, smartphone and tablet that is currently being led by Apple and Google. I'm going to go ahead and turn over to Ben, who's going to give you a comprehensive Yahoo overview.
Thank you very much, Stefano. Hello, everyone, and thank you for your time. My name is Benjamin Dalusma, and I'm here to talk to you about Yahoo, the company. I'm going to present our main takeaways in our analysis of what we understand Yahoo's corporate strategy is and how well the company is doing financially. Founded in 1994 by Jerry Yang and David Filo, Yahoo is, to use Marissa Mayer's own words, a company that helped define the consumer internet as a daily habit for hundreds of millions of users across the globe. In fact, Yahoo is a pioneer in internet search, internet advertising, and is one of the first companies that really helped understand how other companies in that sector can actually generate cash and revenues through the internet. Based in Sunny Valley, California, Yahoo has more than 14,000 employees in 25 different countries. Traded on the NASDAQ, Yahoo's IPO was in 1996, and at the time, the stock was priced around $13, but the adjusted split price was around 54 cents. Today, Yahoo is a company whose stock is priced around $27 with an enterprise value over $27 billion with yearly revenues around $5 billion over the past 3 years, even surpassing the $6 billion mark in 2012 and projected to do as well in 2013 and 2014. 70% of Yahoo's business is located in the Americas, while 30% of Yahoo's business is located in the rest of the world. This indicates that there is a world of opportunities in countries outside the US, especially in emerging markets, once those countries start to master the art of internet advertising and start to understand how search engine optimizations can help them improve their business. In the past 4 years, there's been a shift in the way the information technology business and the electronic advertising business is being done. In fact, in the past 3 years, the average consumer of electronic advertising has been logging on the internet via a mobile device, either a tablet or a smartphone. This is why we believe, as Stefano mentioned earlier in the presentation, that Yahoo's growth needs to be through mobile. Mobile is the future of Yahoo, just to use Marissa Mayer's own words once again. Under the new leadership of Marissa Mayer, Yahoo has had an excellent mobile strategy that consisted mainly in talent acquisitions, mobile app development, and a shift of funds to a new mobile department. In fact, in the past year and a half, Yahoo has acquired 19 companies to enhance the company's mobile presence, most notably the British popular app store, Sumly, and the most popular microblogging platform in the world, Tumblr. The app redesigns led to an increase in both active daily users and time spent on the app. Finally, as mentioned in the slide, there's been a shift in R&D and to a focus on mobile. In order to have more insight on Yahoo's corporate strategy's strengths and weaknesses, we constructed a SWOT analysis. The result of the SWOT analysis indicated that Yahoo's strengths are mainly in its enhanced reach in the world. More than 400 million users go through Yahoo's main homepage, main portal. So there is an enormous reach to users, and this is basically a strength for display of advertising. Second point of Yahoo's strength that we noted was the search agreement with Microsoft. This search agreement guarantees Yahoo a share of the revenue that Microsoft generates through their search engine Bing. And this also increases economies of scale for Yahoo. The third point that we believed was a strength for Yahoo was the increased multi-platform offering and social network integration. In fact, Yahoo is present on desktop and on mobile devices, but other products and services such as Flickr and Tumblr meshes really well to improve vertical integration through mobile. The third strength that Yahoo has is a financial strength. Over the past year and a half, the stock has improved and has beaten all analysts' expectations. Fourth point that we indicated as a strength was the homepage revamp. Yahoo had not changed their homepage in 4 years, and they recently changed their homepage and changed their logo. This really adds up to the company's image to the world. Finally, and most importantly, Yahoo's main strength resides in the power of its brand and its diversified content. Strong brands such as Yahoo Mail, Yahoo Finance, and Yahoo Sports are leaders in their respective industries. And they really give Yahoo an edge in this content business and really represents a huge advantage for display advertising since so many users go online through those portals. The second point of our SWOT analysis was the weaknesses. For Yahoo's weaknesses, we noted 3 main weaknesses. The first weakness was that Yahoo is not as diversified in terms of product compared to other competitors such as Microsoft and Google. Yahoo does not necessarily have a search engine, a web browser. Yahoo doesn't develop operating systems for phones nor tablets. So those are weaknesses that really cause Yahoo to have weak performances compared to peers, since most of their business is based on advertising. Matter of fact, 80% of their business is based on advertising. Finally, because of those weak performances compared to peers and this lack of diversification, Yahoo has a weak market position in the key advertising segment compared to other competitors such as Google. We identified many opportunities for Yahoo in the next few years. The business has plenty opportunities, and this is a great news. The first opportunity that we had identified was the sustainable growth in search advertising. In fact, as we noted earlier in the presentation, 70% of Yahoo's business is located in the Americas, which means that there is a lot of room to improve on other countries outside the US and outside the Americas. Only 30% of Yahoo's business is located outside the US. And once other countries and emerging markets start mastering the art of online advertising, we can expect sustainable and exponential growth in the search advertising business. Finally, second point of our opportunities are the display of advertising and mobile ad on mobile content. Mobile apps haven't necessarily gained nor understood the way to advertise in the right way. And once Yahoo masters and the entire mobile technology industry masters the way advertising is being done on mobile devices, this will represent huge growth and potential increase in revenue. The third point of the opportunities we noted for Yahoo is a point that we noted in the weaknesses. We believe that there are many other product development opportunities for Yahoo, such as cloud computing, web browsers, and even an operating system for a mobile device. The fourth point that we noted was an opportunity for Yahoo was the gaming platforms that Yahoo has been acquiring in the past year and a half. And those gaming platforms will increase mobile advertising revenues, and I'm pretty sure, we're pretty confident that those revenue will start to kick in the next year and a half. Finally, the last point of Yahoo's opportunities is in the mobile apps revamp. Apps such as Yahoo Weather and Yahoo Mail have attracted many new users in the younger generation and really helped reshape the brand of the company to the younger generation. And to use Marissa Mayer's own words, she really wants people to use those apps and come back. And that's what apps such as Yahoo Weather and Yahoo Finance have been doing for Yahoo right now. And we'll finish off this opportunity slide for Yahoo by quoting Casey Newton from TheVerge.com that wrote in an article that Yahoo has 100 million more mobile users than it had 3 months ago. So we can only imagine that this growth and this steady increase will be constant and stable throughout the next year and a half and the next few months. The final point of our SWOT analysis is in the threats. Just as the weaknesses, we noted 3 main threats for Yahoo. The first threat was the increased dependence on advertising revenue that really exposes Yahoo to business cycles. More than 80% of Yahoo's business right now, of Yahoo's revenue right now, is due to advertising. And this is pretty much a consequence of the lack of diversification, product diversification that we noted earlier in the weakness section. But it really exposes Yahoo to many problems that may occur, especially with business cycles. The second threat that we noted was the severe competition from many other sources. Google, as usual, the industry leader, but right now, Facebook is a big player in the information technology business, and other source of competition is coming through other social networks and other social websites such as LinkedIn and Pinterest. And the final point of the threats is that we notice analyzing the income statement that R&D expenses has been decreasing at a steady pace over the past 5 years. And this explains the lack of innovation from Yahoo's part and the need for acquisition and all those acquisition that Yahoo has been doing in the past year and a half. This is a threat that CEO Marissa Mayer has been addressing in the past 6 months, especially with her plan to bring to Yahoo 30 PhDs and her plan to shift funds to the R&D development. So we believe that this threat may become an opportunity in the future. After analyzing the corporate strategy from Yahoo and the company in a more qualitative way, we analyzed how well the company was doing financially, and we gathered around some key financial metrics that we want to present. The first chart above shows us historical revenues and net income over the past 5 years. And as we can see, revenue has actually been decreasing in the past 5 years. However, net income has been increasing exponentially in the past 5 years. This indicates that Yahoo has been doing an excellent job managing costs and cutting costs. The second chart shows us revenue segmentation. And while 19% of Yahoo's revenue is due to listing and other marketing services, and most of Yahoo's business and Yahoo's revenue is due to display of advertising and search. 38% of Yahoo's revenue is based on search, and 43% of Yahoo's revenue is based on the display of advertising on their homepage. The third chart in this slide shows us historical margins, gross margin versus profit margin. And while gross margin has been slightly increasing over the past 5 years, even though it's mainly uniform, it's mainly constant, with a slight increase in the past 5 years, profit margin has been increasing in the past 5 years. And this is a direct result of net income increasing in the past 5 years. And this is also a direct result of the fact that Yahoo has been managing its costs very, very, very effectively. And we'll analyze this in the next slide in our income statement analysis. The last chart on this slide shows us historical earnings per shares in the past 5 years. And there again, earnings per share has been increasing in the past 5 years, with a huge increase in 2012, surpassing the $3 per share mark. We analyzed the balance sheet and the income statement, and our financial statement analysis gave us a lot of takeaways that we can present right now. For the balance sheet, we noticed that the return on asset percentage has been increasing over the past 5 years, and this indicates that Yahoo has been using efficiently their assets to generate income. In 2012, the return on equity the return on asset for Yahoo was 100% higher, more than 100% higher than its main competitor, Google. And the main conclusion from that is Yahoo has been really doing a great job to increase profitability as the company is improving. The income statement has shown us a lot of important details on the company's financial. For example, as we noted earlier in the previous slide, Yahoo has been doing an excellent job reducing expenses and effectively increasing net income by more than 50% in the last 3 years. As we can see in this chart above, net income has been increasing in the past 5 years, whereas selling, general, and administrative expenses has been decreasing in the past 5 years. And net income has actually surpassed selling and general and administrative expenses in the last 2 years. All the income statement ratios, such as the EPS, the gross margin, and the profit margin that we showed earlier in the previous slide, have been increasing in the past 5 years. And this is what we pretty much talked about in the previous slide. And finally, we noticed that Yahoo has close to no leverage, $0 of interest expense in the past 5 years. And this is an important consideration to take over for the rest of our presentation. Let's analyze Yahoo's capital structure. Since their IPO in 1996, Yahoo has financed their operation through the issuance of equity every year. This is fairly common with the technology industry. Companies usually don't necessarily issue debt. It's mainly they finance their operation mainly through equity issuance. From 2005 going forward, Yahoo has repurchased its common stocks on a yearly basis, sometimes even exceeding the amount of money that they issued at the beginning of the year. For example, in 2012, Yahoo issued $218 million of common stock and repurchased more than $2 billion of common stock. This can only explain us why Yahoo's weighted average cost of capital is solely influenced by the expected return on equity, since there is close to no debt. And this is computed through the capital asset pricing model. We also created a competitor comparable analysis table to pretty much have a better sense of how well the company is doing compared to other competitors. We analyze metrics such as market caps, revenue, gross margin, EBITDA, operating margin, net income, EPS, PE ratio, price to sales multiple, and the corporate credit rating. And we also considered 4 other companies that have similar business to Yahoo. Its main competitor, Google, the new star in the information technology business, Facebook, Microsoft, and AOL, another information technology business that is specialized on search and email providing. What we noticed from this competitor's comparable analysis was that Yahoo had a relatively low PE ratio and PEG ratio compared to other companies, indicating that the company might be undervalued. Yahoo has a higher price to sales multiple than any other competitors other than Facebook. Finally, as we noted earlier in the presentation, the company has been doing very well in terms of gross margin and profit margin over the past 2 years compared to competitors. I'll now pass it on to Stefano, who will give us more insights on the revenue forecast model and on some sensitivity analysis and other stuff about our financial considerations. Thank you. Thank you very much.
This is Stefano again. I'm going to go ahead and talk to you about our free cash flow to the firm model and our major takeaways from our model. So first, to start off, we have our revenue forecast right here. We have our growth rates going all the way up to 2023. These growth rates were compiled using Bloomberg. Particularly, these are analyst forecast estimates for Yahoo. We think that these analyst forecast estimates were appropriate in our model because it takes into account all the different opinions that all the analysts has and aggregates them in one number. So we think that's what would help us give us a clearer picture and a full picture of what Yahoo's growth rates and revenues would be. As you can see, in 2018 and 2019 we have negative numbers. We believe this is attributed to the fact that in those years there's going to be an economic slowdown, but not a depression, but just a slowdown. So some of the key drivers of these growth rates is the 34.3% internet penetration rate that we talked about earlier. We believe that there's still a lot more users to come on the internet, and that's definitely something that Yahoo is going to gain from. We are very excited about what Yahoo's management is going to do with the company, and we agree with Yahoo's mobile focus, and that's definitely going to aid them in increasing their revenues. And as we talked about earlier, Yahoo's acquisition of many startups isn't partly due to gain their proprietary technology, but also as a way to acquire a lot of young talent that can help to further spur growth for Yahoo. Some of the assumptions is again that internet usage is going to increase around the world globally. Again, this is a conservative forecast. We think that there's going to be a moderate turnout of Yahoo within this our revenue forecast. We think that Yahoo is going to have a stagnant market share, and we believe there's going to be increased competition as more users come into the world. Some of the risks that are inherent going to the future with Yahoo's revenue forecast is consumer privacy legislation. There's a couple bills right now in the U.S. Congress debating whether an internet user can opt out of collection of data, personal data from them, and if they were to opt out, this would be information that advertisers could not use. So that could be something that could be harmful to Yahoo's revenues. As there's increased competition, there will be correspondingly decreasing margins in display and advertising. And a really big risk we feel is social media. We've seen how Facebook has attracted a lot of users on a daily basis, and this has really taken away users that Yahoo could have used to spur their revenues. So let's go ahead and just talk about our free cash flow to the firm model using these growth rates and revenues that we have right here. So here's our free cash flow to the firm model. Like I said, it's the same growth rates that we had on the previous slide. Some of the assumptions that we had in this model is our operating margins. We believe that Yahoo is going to effectively manage the company and effectively manage their operating expenses, which will lead to an increases in their operating margins as the years go by. We used a constant tax rate of 35%. And for our reinvestment rate, we calculated that using the growth rate divided by the return on capital. Again, our assumption to stay consistent with our assumption that operating margin is going to go up. We believe that return on capital is also going to go up. And our discount factor was used computing Yahoo's weighted average cost of capital, which we computed to be 9.11%. And just to know, all of these numbers right here are presented in thousands, so except for the enterprise value. And we will have attached later on in the appendix of our presentation the full model if you would like to look at it. Using these different assumptions and the revenue growth rates, we came up with an enterprise value of approximately $29.9 billion, which is close to what Yahoo is currently valued at right now. Here are our model conclusion. We have what we think would be the estimated price per share using our model. As you can see, it's slightly above what Yahoo closed on August 17, 2013. So just again, this is a conservative estimate, a conservative model. So let's go ahead and switch over to our sensitivity analysis of our free cash flow to the firm model. So here in this chart, we plotted the different terminal values that Yahoo would have with different terminal growth rates and betas. So for example, if Yahoo's beta would decrease to 0.75 and the terminal growth rate would be 20.25, there would be a big increase in the terminal value, which will lead to a much more higher final valuation of Yahoo, because a major component of any DCF model is the terminal value. So we thought it would be a good idea to just plot different numbers using different terminal values. On the flip side, say if the beta was at 1.15, it would be approximately 59,000 or 59 million, excuse me. And this is in thousands. So that would be almost half what of our previous number would have been at 100 million. So on the bottom here we have some of financial metric samples. We use the constant beta of 0.95, which is the beta that we use in our current computation of weighted average cost of capital. The only difference is that we use different terminal growth rates. So for low, we use 1.125%. For medium, we use 1.75%. And for high, we use 2.25%. As you can see here, if there's an increase in the terminal growth rate, there would be a definite change in the enterprise value. So say if Yahoo's terminal growth rate, if analysts believe that there's a great turnaround in Yahoo's operations and they decide to attach a higher terminal growth rate, maybe a growth rate of 20.25%, Yahoo's share price can ultimately go up to 30.14, which is about $3 a share higher than what it is currently valued right now. And its PE ratio would go up to 8.30, and the enterprise value, or the multiple of enterprise value divided by EBITDA, will also go up to 25.76. So this slide is just to demonstrate all the different valuations so Yahoo could have once there's a turnaround that cements financially. So let's just go ahead and summarize our findings. So as I previously mentioned, a major component of the DCF model is derived from the terminal value. So again, if once Yahoo's turnaround cements financially, we expect there will be an increase in equity value. So once analysts see that Yahoo is capturing more of the market, they're attracting more users, we believe that analysts will attach a higher terminal growth rate, possibly a terminal growth rate of 20.25%, which would lead to a stock price of 30 and 14 cents. And again, we just want to talk about the weighted average cost of capital. It's driven mostly by equity, since Yahoo's capital structure is mostly comprised of equity. So taking into consideration that Yahoo currently has no interest payments and has high liquidity in terms of their cash and short-term assets, and due to the fact that we believe that Yahoo is going to have an increasing operating profit margin, and because the weighted average cost of capital is driven by the high cost of equity, we think that Yahoo should issue debt to finance their general corporate purposes, operations. We believe that issuing debt will help Yahoo's ultimate goal of maximizing firm value for the two following reasons. The immediate reason is that the weighted average cost of capital would decrease due to the tax benefit that is associated with issuing interest-bearing debt. There would be an increase in earnings, and also Yahoo's valuation would increase due to the lower discount that would be used. Secondly, as we mentioned earlier in our Yahoo finances their operations through the issuance of equity. Purchase program, which is usually a much higher than what Yahoo uses to finance their operation through equity. So if Yahoo were to issue debt to finance their operations, Yahoo could effectively use more money to buy back more shares, which would have the immediate effect of increasing stock price. So right now I'm going to go ahead and turn over to who's going to talk about the different processes that would go into issuing a bond for Yahoo. Thank you.
And yeah, I'm here to talk about funding consideration, and we'll begin with Yahoo's credit analysis. So in order to think about an issuance of debt for Yahoo, we analyzed the corporate credit rating that would have been assigned to Yahoo if they issued debt. We pretty much stated already earlier in the presentation that right now Yahoo has close to no debt, and Yahoo has not been rated by none of the major rating agencies since 2008. The last time Yahoo was rated by one of the major credit rating agencies, it was back in 2008 by Standard & Poor's, and it was assigned a triple B minus, which is not necessarily a great corporate credit rating. We believe, however, that if Yahoo was rated today in 2013, the corporate credit rating would be at an A+. Let us explain our reasoning of this discrepancy between the two corporate credit ratings. Back in 2008, Yahoo's market share, revenue, and net income was shrinking. Yahoo was in the middle of a crisis with more than $800 million of debt. Potential target for Microsoft at the time, Microsoft wanted to acquire Yahoo, and this pretty much loaded the fact that the major rating agencies were afraid for Yahoo's future. Also, back in 2008, the industry structure was changing with the introduction of mobile phones and mobile advertising. And there was a lot of questioning by Standard and Poor's of whether Yahoo was still a competitive business or not. Another point of Yahoo's low corporate credit rating was the instability in management. In fact, around 2008, Yahoo had a great instability in management. Multiple CEOs were trying to bring the company back on track, and this really created a lack of uniform leadership that we didn't necessarily have in 2008. Finally, back in 2008, the price of the stock was decreasing, and I believe in 2008, the price of the stock was around $14, was around $14 to $13, which is around the lowest point ever had in the past 10 years. The situation has changed in 2013. Revenue, market share, and net income has been increasing in that period in the last 2-3 years. Also, today, instead of those $800 million of debt, Yahoo has close to no debt, which is very favorable for a corporate credit rating. Second of all, Yahoo is not necessarily a target for Microsoft, but has a strategic partnership with Microsoft and a strategic partnership with other companies to enter the mobile market. Finally, another point of contrast is the stable leadership in the price of the stock that's been increasing over the past few years, which is a huge contrast compared to Yahoo in 2008. In fact, Marissa Mayer has been around for a little bit more than a year now, and she's here to stay. She has a contract for 5 years, and she's been doing a very good job bringing the company back in track. And also the price of the stock has been increasing in the past 3 years. So we believe all those assets, all those advantages would have brought Yahoo an assumed corporate credit rating of A+ instead of a BBB- since the situation has changed then. Let's try and take a look at the current bond market right now. So right now, we all know that interest rates are extremely low. It's an historical low, and as we can see in the graph, from 5 years out to 3 months prior this date, interest rates have been decreasing. The U.S. Treasury bond, with a maturity of 3 months, had a negative yield. A maturity of 6 months had a yield of 0.03% as of yesterday. The 2-year bond, U.S. Treasury bond, had a maturity yield of 0.32%. The 5-year bond had a yield of 1.52%, while the 10-year bond had a yield of 2.79%. In the corporate world, the corporate bonds with 2-year maturity had a yield of 0.88%. 5-year maturity had a yield of 2.43%. 10-year maturity had a yield of 4.04%, and 20-year maturity had a yield of 5.17%. So pretty favorable time to actually issue debt since the interest rates are not particularly high. Let's talk about the term sheet and the financial opportunity that we considered. We are recommending Yahoo to issue a $200 million bond with a 3.8% coupon rate with an assumed corporate credit rating of A+ from Yahoo. The minimum denomination would be $100,000, and the maturity would be 10 years from the closing date. And we also think that the use of the proceeds should be should be for general corporate purposes. I'll pass it on to Kelly, who will talk about our roadshow recommendation and our institutional investors. Thank you very much.
Thank you, Ben. Now I'll talk about our roadshow recommendation. On day 1, we will be traveling to Boston, Massachusetts to meet with the key management of 3 of Yahoo's institutional investors. We will be meeting with Fidelity Investments, who currently own 5.53% of Yahoo. We will be meeting with Wellington Management, who currently holds 4.49% of Yahoo. And finally, we'll meet with State Street, who owns 1.29% of Yahoo. On day 2, we will travel to Libfraind, Pennsylvania, to the corporate headquarters of Vanguard to meet with their key management. Vanguard currently holds 4.27% of Yahoo. On day 3 and 4, we'll be in New York City to meet with the key management of 4 of Yahoo's institutional investors. On day 3, we will meet with the management of Third Point, who is Yahoo's largest institutional investor with 6.8% of the company. On day 3, we will also be meeting with the Bank of New York Mellon Corporation, who currently owns 1.75% of Yahoo. Now on day 4, we will be meeting with BlackRock, who currently owns 2.5% of Yahoo, and we will also meet with Deutsche Bank, who holds 1.29% of Yahoo. On day 5, we will be traveling to Atlanta, Georgia, where we will meet with the key management of Invesco, who currently holds 2.48% of Yahoo. So day 6 is our final day of the roadshow, and we will be concluding in Los Angeles, California, to meet with the key management of the Capital Research Global Investors Group. They currently hold 1.86% of Yahoo. And that concludes our roadshow. So in conclusion, we would like to make a recommendation for Yahoo's newly acquired funds. We believe that Yahoo's efforts should be focused on offering a new experience to customers to make them believe in Yahoo again. They should do this in 3 ways. First, strategic acquisitions, which will allow them to increase their corporate talent. 2, we believe that Yahoo should expand their mobile app presence. Yahoo's revamped weather app, their Yahoo Finance app, and their sports app are great examples of what Yahoo should pursue. And finally, we believe that Yahoo needs to develop more products. One example of a product they could develop would be a web browser. However, we believe that Yahoo should really develop continuity between their products because this would really enhance the customer experience. Thank you.
And that concludes our presentation.
Thank you very much for your time, and I really hope you really appreciated our work.
Please reach out to us if you have any questions. We're looking forward to doing business with Yahoo and helping you raise capital. Thank you.